hi everyone. I'm here with the one and only Julia Spina, and here it is, the masterpiece by Julia Spina. Yeah, the Unlucky Investor's Guide to Options Trading, the book who just came out by Julia, and it's a book about options, and pretty much focused on just selling options. It's a really complete book, and is actually the title sums it up. It's a guide for you to trade options, to do the best strategies, and how to sell naked options, how to volatility, and all this kind of stuff. So Julia is just this is the copy I downloaded from. I bought it on Amazon and I downloaded to my Kindle. You can download it from your mobile device. Here in Brazil, we cannot buy the book, the actual physical hardcover book. But Julia, it came out on last month, right?
Yeah, it came out on February 23rd. So like about a month ago, maybe a little bit more. I apologize in advance for the e-reader version, because I think it's a lot harder to read than the physical copy. You can still get through it, but the graphs are all over the place. The tables will be on different pages, but everything's in there, so that's good. I think they did a pretty good job.
Yeah, so congratulations, Julia, on the book, and thank you for finding some time to chat with us today. So we talk a little bit about strategies and about options trading, but first, Julia, how you came up with the idea of writing the book? What inspired you to do it?
I wish I was smart enough to come up with the idea. It was actually Tom's idea. He kind of wanted some researchers to write a book, and it was Anton and I that kind of put the whole thing together. Anton was kind of more of a big picture guy, so we were collaborating on what kind of content to include. But like in the bigger picture, I guess, like retail trading, options included, have just become way more accessible in the past couple of years, now that like markets are becoming more available, and now that online trading is getting more popular. And I think like option traders make up like 25% of the daily options activity or something along those lines, which is nuts. So it's awesome that people are becoming more comfortable with risk and motivated to do their own investing. But these are also like pretty complicated instruments, and there are a lot of pitfalls that can be absolutely detrimental to even the most experienced options trader, but especially new ones. So like when I started self-studying finance, I found that a lot of the resources were pretty complex. They were pretty theoretical, geared more towards academics or industry professionals. And there seemed to be kind of a need for something that was a little bit more approachable, a little bit more accessible, more actionable, especially, and something that was really specific for the retail market. So the book was really our way of filling that void by taking a bunch of the content that the research team has been developing for the past like 9-10 years and putting it into like a book form that's a little bit more condensed, a little bit more easy to read, if that makes sense. I think going through all that content.
Yeah, no, it was really easy to read. Actually, in the first chapter, in the beginning of the book, you start to you talk a lot about the formulas and the more theoretical part of options. Since you have a background in physics and mathematics, right? So that's why you put some formulas and some part of the options theory in there. You seem to like this kind of thing, right?
Yeah, it's one of so like the first chapter, and I'll admit the first chapter is pretty dense depending on what your background is. The recommendation that I always give people is that like if you start with the math chapter and it's a little bit too dense or not really very intriguing or interesting, like just skim it and then go through the rest of the book and then refer back to that first chapter whenever you need like a reference, like, oh, I need to know what the standard deviation is, go back to that first chapter. It's really like the math, and we talk about this in the book, the math is a means to the end. Like, you need to understand some math, I think, to be able to trade options strategically, but it's not really what you want to be focusing on when you're actually trying to develop strategies. It's something that you kind of just want in the back of your mind to make sure that you're making strategic decisions whenever you put a position on or whenever you manage a position. So it's important for that math to be part of the foundation, but a lot of these models are like very fundamentally incomplete. They're useful for assessing risk and developing reliable strategies in most situations, but they're incomplete nonetheless. And so that's why it's important to have model-free principles as part of your trading foundation, in addition to having some of that math just in the back of your mind a little bit. Does that make sense?
Yeah, no, it's true. It's a good idea to understand the math, to know how it works. But actually, if you know all the concepts on options, all you need is just basic mathematics, right? You need to
exactly
just the basics. You can do well and you can be a successful trader. And,
yeah, I mean, like it's all in there, if that makes sense. Like everything is in there that you would probably ever really need to know, at least at a superficial level. But like there's a lot of options math that even like Tom doesn't know, and he's been trading for years, decades. So it's kind of, it's there if you need it. It's, everything's in there, but it's not the point of the book. It's not supposed to be a math book. It's supposed to be more actionable than that.
Yeah. Well, Julia, so volatility is a big part of your strategy and the basic trade strategy. And you guys always use IV rank. IV rank is just on the platform, is highlighted on the platform. But there's IV percentile too. There's both actually. There's which one do you prefer? Can you talk us a little bit about all those metrics? Which one is the best for you, and the difference between them?
Yeah, for sure. That's a really good question. Actually, it's one that we get quite a bit. So basically, you have IV rank and IV percentile, and they both give you kind of like relative volatility metrics. So like raw IV is not comparable between two different assets. Like if Amazon's IV is 70 and SPY's IV is 40, it doesn't actually tell you how high the volatility is, relative to that history of the individual asset. And so when you normalize something like, when you normalize implied volatility to produce something like IV rank or IV percentile, it gives you an idea of maybe how elevated that implied volatility is relative to its history. And since short options traders are trying to capitalize on that relative IV contraction, that's really important to have some kind of metric there. So just a little blurb about those two and why we use them. So IVR, IV rank, gives kind of a better direct metric for evaluating the price of the option, but IV percentile is more robust. So they both work really well in giving that relative metric, but IVP, IV percentile, is a little bit less sensitive to outlier IV moves. So like if IV spikes 10 points up for a day and then goes back down, that'll skew IV rank pretty significantly. It'll skew IV percentile a little bit less. It's generally less prone to skew when you're dealing with IV percentile. I tend to use IV rank just because we've actually researched those thresholds. Like we've done pieces like what, when we trade IVR over 30, like we actually have research to kind of like back up why we do that. So there's less research regarding IV percentile, but both work really well for decision making. I think that it's really important to note that like both metrics are prone to skew, both can be relatively volatile. And even though IV, even though it's not comparable between metrics, it doesn't give you that kind of like relative measure that we need. It does give you the most direct representation for like how rich the premium of an option is. So I think it's generally really important to use both. So you want to use some kind of relative metric like IVR or IVP, but you also want to look at the raw IV because that kind of tells you how much premium am I getting relative to the amount of risk that I'm taking for a specific instrument. So I tend to use both. Does that answer your question?
Yeah, no, pretty much. And then that's pretty much how I do it too. I always look at the IV and the IV rank, and I look at them both. And sometimes you may even find some distortions here, some trading opportunities in this situations. And so let's talk a little bit about this very interesting concept on the book, that is this low period, right? You have this it's low. It's how you say low, right? It's low.
We say lull, but I know what you mean.
Yeah, low. Yeah, this low period is to me, it's like we used to say here, the market's like when you start a roller coaster, and the roller coaster starts going up really slowly, and then it goes down all of a sudden. So this low period will be pretty much like the start of a roller coaster, and you start going up really, the market goes up slowly and then goes down really fast. I don't know, it seems like a good way to look at it. So are there any research on how long this low period takes? Because you may find a good trading opportunity there, because you may look at, implied volatility is being low for so long, is over the mean, and then it might crash sometimes. The crash might be coming soon. Is there any way to trade these? Is there any research on these? How long does it take? Any way you can trade this, the low period?
Sure. So we've actually tested this. I think we did a market measure back in like March of 2020, so a while ago. But I think we found in that study that the average VIX lull was maybe like 40 something days. I think it was like 42 days. But the problem is when we're trying to use that as kind of like an indicator, like we've recorded lulls that were only a few days, and then we've recorded lulls that were 96 days or even longer than that. So even like the VIX closed at like 18.5 a few days ago, that's below its long-term average. So now technically we would have been back in a lull period during that time, and now it's back up to 24. So we can see that there's a lot of variability in how long these periods tend to last for. And a big takeaway in the book is that it's really difficult and maybe even impossible to like consistently time the market. So the fact is that these really big moves and these really big vol expansions that tend to kill short premium traders are usually the result of very impactful, unexpected events, such as the pandemic or the Russian invasion of Ukraine, things that like people didn't really see coming that had a larger impact on the market than what investors were expecting. So, so for example, like China went into lockdown about a month before the US, and investors knew that something was brewing, but that uncertainty wasn't actually priced into the market until after our economy was already impacted, and nobody was really expecting that to happen. So timing events like this, the really big ones, I guess, that can really be detrimental to a short premium trader, they're, you know, because they're so specific to the current state of the market, it's really, really difficult to do that consistently. So I would say that like we have data on how long those lull periods last, but because we need to really focus on those kind of black swan events as kind of like the primary risk factor that we should be considering, it's kind of, I don't know if like looking at historical data of the VIX period is really a good way to do that. Does that make sense?
Yeah, no, perfect. Well, talking about those black swan events, I was looking at the before the 2008 crisis and before the 2020 March, the meltdown from the COVID crisis. And volatility was trading really low before those periods, just days before those periods. When volatility is really low, when the VIX is really low, you think it's a good idea just to not sell naked options, just do defined risk trades, and or maybe when there's a VIX level, you say no, this VIX level is too low for me, I'm not selling naked options, or this VIX is low, or this VIX level is too low for me, I'm not even selling options here, I'll do something else, I'll just wait for the volatility to expand. There's any level what you do in a really low volatility environment when obviously the risk of a black swan or a big meltdown is higher?
Right. I think, and that's a really good question, because you're right. Like, at least historically speaking, it's difficult to make this claim generally, but historically, when we've tested this, the risk of an outlier vol expansion tends to be highest when IV is low. And the best way to account for that risk is really by limiting the amount of capital exposed in those low volatility conditions. So short options, and when I say short options, I'm referring to like 30 to 60 day contracts with deltas between 10 and 40, just because those are the ones that we've tested and those are included in the book. But those positions are profitable in all volatility environments. And in order to get that large number of occurrences to reach those positive long-term averages, or at least to be more likely to reach them, it's important to trade at all VIX levels, even when the VIX is really, really low. And like I said, the most effective way to kind of like mitigate the risk of those expansion events when you're actually trading is by limiting the amount of capital. And another thing that you said, which is what I also do, is that I like to trade like wide defined risk strategies in those volatility environments. So I'll trade like wide iron condors or wide spreads when the VIX is really low and I'm worried about an outlier expansion. So like a wide iron condor, such as one that has like short 16 delta strikes and long like 6 delta strikes, it's basically a synthetic strangle. So your pops are still high, but your risk is defined for those really, really large moves. So that's kind of like what I tend to adopt. So even though like you will take significant losses on that type of position, it's not the same as having like a naked option or some kind of undefined risk strategy on. So yeah, I think that's a great question.
Yeah, no, perfect. That's what I was thinking actually. And in a big sell-off, when the market crashes, the market goes down, a lot of volatility goes high. What I do as a trader, I just go selling them the puts, right? I don't do much of the call sides because market recovers. I understand that even the call gets richer, gets more expensive when the volatility is high. But I think it's a good idea just to sell puts and not doing the strangle when volatility, when the volatility is high, when the market has already crashed.
Another really good question. That's something that we get a lot of when, viewers will ask that a lot when we get emails and stuff. So, in my personal opinion on this is that you don't know really the nature of the sell-off until you're already in it, if that makes sense. So you could have a 2020 sell-off where you have this really rapid whipsaw, and that lasts for 2 months and then the market is basically recovered, or you could have a 2008 sell-off which lasts for 2 years. So there's nothing wrong with trading directionally in those conditions. There's absolutely nothing wrong with trading according to those directional assumptions, and just selling the puts or just selling the calls depending on where you think the market is going to go, or taking the contrarian approach or moving with the market. But I think it's important that if you're trading directionally to have those kind of hedges, directional hedges in the portfolio as well, just in case the market turns against you. So you want that element of diversification even when you're trading directionally, just in case, you want that insurance, right? So it's really a personal thing. There's nothing wrong with selling the puts when the market's tanking. I think that's what a lot of people do, and it works out, but you just don't know the nature of the sell-off until it's already done. Basically, you're just kind of playing it day by day in those conditions.
Yeah.
You
look always to go a little more neutral, right? Delta neutral in your portfolio. And even when the market goes down a lot and the puts are, you can sell SPY puts I don't know, 30-20% below the price. You go for more delta neutral portfolio.
Yeah, so I tend to trade delta neutral just because when I make directional assumptions, they're usually wrong. So I'd rather just avoid trying to factor in all of the news and all of these different whatever volume or factoring in other indicators. I'd rather just go neutral and kind of let time and volatility do the work. The first trade I ever placed at the beginning of 2020 was highly directional, and it just so happened to work, and I knew that was never going to happen again. So I'm trying a different approach now.
Yeah. What about the buying power of your portfolio? Maybe a trader could start using, okay, I'm going to use 50% of my buying power here. I put some trades on and using 50%. All of a sudden, the market suffers a large move and you're using more. You're using, I don't know, 70, 80% or even more of your buying power. You think it's a good idea just to manage that, or say, I need to reduce a little bit of that, because probably you're going to have to assume some losses, right?
Yeah, that's a really tricky question. It really depends on the person and the situation. So, and we write about this in the book, 50% is the maximum you ever want to allocate to short premium, just because if something like that does happen, you want that portfolio capital to cushion those potential losses, and you really want that reserve capital to be able to capitalize on those high volatility conditions where you have very rich premiums. So it really depends on the person and the constraints of the market. So for instance, in the last couple of weeks, I had a bunch of positions, or even since 2020, I had a bunch of positions that would dip into the money, and then I would just kind of wait it out to see if they would kind of bounce back, and that's what wound up happening. So in those conditions, for instance, even though my buying power went up, I didn't actually manage the positions, and I just wanted to wait it out because of the duration of the contracts. If you're dealing with that situation and you're dealing with 10 DTE contracts where the volatility of those positions are very high, it might make more sense to sort of close those positions, recenter, take some losses, and then try to capitalize on the volatility contraction that's a little bit more likely now that IV is elevated. Does that make sense? It really depends on how much risk you're willing to take given the current conditions. Yeah. More so than, does that answer your question?
Yeah, no, the conditions change. They change pretty rapidly, and each environment is different from the other, right? And sometimes you're in a position where you have a lot of options that are closer to expiration. You might just want to close those ones. and move a little bit and roll some positions. Even just by rolling, you might start using less capital, much less capital, right?
Yeah, exactly. That's what I tend to do. A lot of it depends on the duration of the contract, because I really want to think like, how efficient is it for my capital to be allocated to a certain position? So like, for instance, if I have a position on, and even if it's profitable and there's only like 10 days till expiration, then is my capital more, is it being used more efficiently in terms of profit generation to close that existing position, add it to a new position, instead of trying to get as much extrinsic out of the first position as possible? Like that's part of why we manage at 21 days. When we look at the mechanics, it's because usually because your profits are generated so heavily during the first half of the trade that it's generally more efficient to allocate to new positions or to roll or to recenter existing positions. That's generally the stance that I tend to take. But in terms of managing losses, for me, it really depends on how big those losses are. So like we've tested this, for instance, on the network at, once a position tends to lose about like 2x the initial capital or 2x the initial credit, that's when like the probability of a turnaround starts to drop off pretty significantly. So, and you can solve that with stop losses, for instance. But if it's a more moderate loss, because P&L swings are so volatile with short options positions, a lot of the time, at least for me, it makes more sense to just kind of hold the position and try to let it recover. But it is really a personal choice. It really depends on how much risk you're willing to take and how efficiently you think your capital is being used when it's tying up a specific position and vol is just expanded.
Yeah,
Does that make sense?
Yeah, perfect, Julia. Perfect, great. And you follow those mechanics strictly. I talked to Jim actually a few weeks ago, and he follows sometimes. Sometimes he just do his own way. You follow those the 45-21 rolling and 50% closing the position at 50% profit. You follow those strictly?
Not really. I mean, I do, there are aspects of the mechanics that I really agree with. So for instance, if you're trading short premium, sticking between 10 and 40 delta, I think that totally makes sense. You want to stay, liquidity is like the most important one that I follow very strictly. But in terms of like management, I tend to manage at credit thresholds rather than durations. So for instance, like if I have, and this happened with a position recently, if I have an XLE position on, like for me, at least those positions didn't start actually generating profit until way past halfway through the trade. So I'll just leave the position on past 21 DTE just to see if I can get any extrinsic out of it, as opposed to looking for a new position. And that might be a better use of capital depending on the volatility of the market. So if the VIX is low, does it make more sense to get more extrinsic out of a certain position or to put it on capital to a new potentially lower IV position? And yeah, I don't know. I generally trade mechanically, but not always. It really depends on, you got to use your gut, I guess, thing for a lot of this trading, depending on like whether you think the position is going to recover, whether you think that you're going to extract a certain amount of capital out of an existing position. And then with rolling, that's something I tend to not really follow, just because like when a lot of people consider like when you roll a position, you're trying to get a certain amount of capital back for a loss of the position that you've already had on. And that's not really how I see it. I see it as a totally new position. So for instance, like if I take a position and manage it at a loss, and then I'm considering rolling or like putting the same position on again and letting that go for another duration cycle, I would only do that if I would place that trade again totally on its own, if that makes sense. So like rolling is something, the rolling mechanics are something I don't really follow, just because I see trades as sort of like individual entities, if that makes sense.
Yeah, no, perfect. I guess that the mechanics are a good guideline. It has a good advantage, that is, you take the emotions off the game a little bit. This is something that works, I should be doing, and you don't have to make too many decisions, and you remove the emotions a little bit when you're in that situation, actually.
Right, exactly. And you bring up a really good point. Like, it's important to trade mechanically. It's important to have like a consistent strategy when you're actually trying to develop a portfolio and have certain expectations around your profits and losses. But like, our mechanics are not necessarily the best mechanics for an individual trader. So like, they might have their own sets of mechanics that are like, variations of the mechanics that we use, like me and Jim and whatever. But it's important to have that consistency either way. So like, whether it's our mechanics or your own mechanics or some modified mechanics, like, it's important to have some kind of structure in place, just because otherwise you can't really get any sort of reliability or more definite expectations around future performance. And that's something that we really try to aim for when we trade, right?
Yeah. People are different. Some people, some people have much more tolerance to risk than others. And I think that this is the main difference between the traders, and the risk tolerance from the difference between risk tolerance from one trader to another. And what about here in Brazil? We have one ETF that has liquidity in options, only one ETF. And you have a lot in USA. So when volatility is high, you think it's a smart thing just to trade ETFs? SPY is when SPY is at 30, I don't know, over 30, and you say, oh, okay, I'm just gonna trade SPY in these situations, or I'm just gonna use some ETFs. You think it's a smart thing just to trade ETFs and not the individual stocks? You actually answered that question on the book, but since most of our viewers haven't read the book, so it would be good if you talk a little bit about that.
For sure, and that's a really good question. So you're right that so for ETFs, high volatility conditions don't come around that often. So when SPY hasn't, on IVR above 30, that's a relatively rare occurrence, even though it's happened a lot over the last, 2 years. Yeah. So ETFs, because they're diversified, because they're a little bit more stable and less sensitive to company and sector specific factors a lot of the time, that's what I generally tend to trade when those IVs are high. So when, there's rich premium, that's when I would prefer to trade ETFs if I have the option. I generally try to stay away from single stocks because you have events like GME, because you have the Facebook earnings event from a few months ago, you have the Tesla rally of 2020, and you have those those idiosyncratic risk factors, which is what we call them, can be really detrimental to an overexposed short options trader. So generally I try not to trade them if I can, but because it's so important to have that high IV and that, rich premium, and because that doesn't happen very often with ETFs, a lot of the times stocks are more suitable, to capitalize on that richer premium. So what I normally do is I generally stay away from earnings trades. So if I'm going to, trade single company stocks, I generally want to be pretty far out from earnings. And if I do make an earnings play, it's a really, really small position just because of how wild those moves can be. And because how infrequently they happen, we don't actually know whether they're profitable in the long term or not. We can't make that claim because there's too much uncertainty with having so few occurrences. So I generally stay away from earnings trades, and it's mostly if there are no really suitable ETFs to trade, that's when I'll trade single companies. But you also almost entirely trade defined risk. If I'm going to be doing that, I'll either do vertical spreads or iron condors. So that's kind of how I tend to my own personal mechanics, I guess.
Let's talk a little bit more about your personal trading style, Julia. So you like the strangles, you do the strangles a lot, and which delta do you look for selling for the short option when you're doing a strategy in a normal environment? I know that changes with volatility, and in a normal environment, what do you do? What kind of trades you do? What kind of delta do you use? Talk us a little bit about how you like to trade.
Oh, for sure. That's a really good question too, because everybody's different. And I do tend to do delta neutral strategies. So either iron condors or strangles. I'll do spreads if I need to center the portfolio delta a little bit, maybe I need a little bit of long or short delta. So I'll throw a spread in if I need to balance it out. But generally the limiting factor is the buying power reduction of the trade. So for instance, if it's a $50 underlying and, I only need a few $100s in buying power, I'll do a strangle, or I would prefer to do that as much as possible. But for instance, if I'm trying to get exposure to SPY or the Qs, and maybe that position is too buying power heavy with the strangle, then I would do an iron condor just to reduce the buying power of the trade, because that's really the biggest limiting factor, which is the capital concentration of the position when you're deciding whether to put something on. It doesn't matter if you have a certain assumption, or if you really want to trade defined or undefined risk, or you really want to get a certain pop. If the buying power is too high, that is not a good trade relative to your portfolio capital, right? So generally you want your portfolio, your position sizes to be 5 to 7% per position. You don't want kind of more than that in a single underlying or a single trade. You can kind of tweak that rule a little bit if it's a very small account. If it's a $10,000 account, then you can't really trade anything, any short premium strategies if you're only doing 5 to 7%. So there's some wiggle room with regards to that. But generally speaking, I'll try to do like wider strangles, or maybe like, depends on the buying power a little bit. If it only takes a few hundred, then I'll do like, I don't know, 16 to 20 delta, a little more on the conservative side. And then I try to do, if I do an iron condor in a stock or a more expensive underlying, I'll try to do it as wide as possible. So, ideally it would be about 6 delta for those long wings. But if it's too buying power intensive to go that far out, I'll usually do like 10 delta for a 16 delta short strike. Does that make sense?
Yeah. Okay, this will end up being like what? How wide is that? Like $10 wide in the iron condor?
Yeah, I think I'm the only person on the show who sets the wing length according to delta, just because like a lot of underlyings are skewed, like gold is skewed, SPY
Yeah,
is
no,
skewed,
I do that too a lot. Yeah.
So I think it works out to be like $10 to $15, but it's asymmetric. So it might be $7 on one side, and $15 on the other side. I think it works out to be like $10, but I generally like to scale the wings to the expected range of the underlying, just because like, if you're going by a fixed dollar amount, then you might be like eating into premium that you could be, getting on one side. So I'd rather have it be a little bit more efficient with regards to pricing, as opposed to using a fixed dollar amount. And not all underlyings have skew. I think Apple, at least historically, was relatively skewless. So usually the dollar amount works, but like for certain underlyings, like that's kind of how I like to trade. So I'd say that's, between like, I don't know, $10 and $15 a lot of the times.
Yeah. What about the management, the trade management? You have a rule to roll the untested side. You do that. You roll the untested side when your strikes get breached, or when your break even gets hit. How you do that? You do those managing mechanics. You just assume losses. How you do that?
That's a good question. So I generally put in stop losses, but they're really far out. So if I do like a 2x stop loss, like 2 times the initial credit stop loss for an undefined risk strategy, that usually works out pretty well. Because usually if you're taking like a 0.5x or a 1x loss, a lot of the time the underlying price will bounce back into the expected range. And so I'm just kind of like willing to take that tail risk and go out as far as 2x. And then like I said earlier, like I don't really roll in the traditional way. Like if a position has, or if an underlying has the characteristics that I'm interested in when I'm reconsidering putting on the trade, then I'll put it on again. So I won't necessarily I'll usually recenter it entirely, as opposed to rolling the untested side out or something like that. So that's what I tend to do. And then for undefined risk positions, I usually don't manage them at all. So just because what the risk is prior to going into position, and because like the buying power reduction, it gives you that max loss, because what it is prior to going into the position, I'll just usually let it expire with a loss, or give it enough time to recover, or give it as much time to recover as possible. So that's what I personally tend to do, but everybody's different. It really depends on your personal preferences.
Yeah. Well, great, Julia. That was pretty much it. It was a great interview. And here's the book. Again, if you want to buy it, you can go to Amazon, right? You can download it. Selling on Amazon, you can download to your mobile device. And here there is a lot of ideas for you to improve your trading style if you like to selling options. Well, this is pretty much focused on selling options. In Brazil, not a lot of people talk about selling options, and there's a lot of training material talking about buying options here. People just do a technical analysis and try to buy the far out of the money option and hit the lottery, this kind of thing. And we're trying to change people's minds here with Julia Spina is a good people for you to follow if you want to leave your social media, social networks, Twitter, Instagram. Julia, just say it.
Oh, so my Twitter is Finance Photon, FINANCEPHOTON. And I'll spell it out for you so that you can put it in the description or something. But,
right.
We have trade ideas that we put on the show, and I'll post about them sometimes. And thank you for having me on. I had a great time talking with you. I hope it was helpful for your viewers. books on Amazon. We're happy to send out any other information if you guys have any questions.
Okay, great, Julia. Thank you. Thanks a lot, and have a great day. And maybe we can chat again sometime.
That sounds great. Thank you.
Thank you. Bye-bye.